Starting with investing can seem daunting, but it's a key step towards building wealth and securing your financial future. Here are some foundational steps to get you started. Educate yourself. Understand basic investment concepts. Learn about stocks, bonds, mutual funds, ETFs, exchange-traded funds, and other investment vehicles. Research investment strategies. Familiarize yourself with different strategies, such as value investing, growth investing, and index fund investing. Financial news and books. Follow financial news and read books on investing to gain insights and deepen your understanding. Assess your financial situation. Set financial goals. Determine what you're investing for, whether it's retirement, buying a home, or education expenses. Evaluate your risk tolerance. Understand how much risk you're willing to take. This can depend on your investment timeline, financial goals, and emotional capacity to handle market volatility. Create a budget. Know how much you can afford to invest after covering your expenses and emergency savings. Open an investment account, brokerage account. An account with an online broker allows you to buy and sell investments. Retirement accounts. Consider tax-advantaged accounts like Roth IRAs, traditional IRAs, or employer-sponsored 401ks, especially if they offer matching contributions. Choose your investments. Diversify. Spread your investments across different asset classes, stocks, bonds, real estate, to reduce risk. Start with mutual funds or ETFs. These funds allow you to buy a basket of stocks or bonds, providing instant diversification. Consider robo-advisors. If you prefer a hands-off approach, robo-advisors can manage your investments based on your risk tolerance and goals. Develop an investment plan. Set a regular investment schedule. Consider dollar-cost averaging, where you invest a fixed amount regularly, regardless of the market condition. Rebalance your portfolio. Periodically adjust your investments to maintain your desired level of risk. Stay informed and patient. Monitor your investments. Keep track of your portfolio's performance, but avoid the temptation to overtrade based on short-term market movements. Stay the course. Investing is a long-term endeavor. Be prepared for ups and downs in the market. Seek professional advice. If you're unsure about making investment decisions on your own, consider consulting a financial advisor. A professional can offer personalized advice based on your financial situation and goals. Understanding investment vehicles. Stocks. Buying a stock means purchasing a small piece of ownership in a company. Stocks have high growth potential but can be volatile. Bonds. Bonds are loans you give to corporations or governments in exchange for periodic interest payments plus the return of the bond's face value when it matures. They are generally considered safer than stocks but offer lower returns. Mutual funds. These funds pool money from many investors to buy a diversified portfolio of stocks and/or bonds. Managed by professionals, they offer diversification and are a good option for beginners. ETFs, exchange-traded funds. Similar to mutual funds but traded on stock exchanges like individual stocks. They typically have lower fees than mutual funds and offer instant diversification. Real estate can be direct investment in property or through real estate investment trusts, REITs, which are companies that own and manage real estate portfolios. Advanced investment strategies. Asset allocation. This involves dividing your investment portfolio among different asset categories such as stocks, bonds, and cash. The allocation should reflect your risk tolerance and investment horizon. Dollar cost averaging, DCA. This strategy involves regularly investing a fixed amount of money, which can help reduce the impact of volatility. Tax-efficient investing. Understanding the tax implications of your investments can help you minimize taxes and maximize returns. For example, holding investments longer to qualify for long-term capital gains tax rates. Investment tools and resources. Financial news and websites. Regularly following reputable financial news sources and websites can provide valuable market insights and help you stay informed about economic trends. Investment apps and platforms. Many apps and platforms offer educational resources, tools for tracking your investments, and automated investing services. Online courses and webinars. There are numerous online courses and webinars available that can provide deeper knowledge on specific investment topics and strategies. Common mistakes to avoid: investing without a plan. Jumping into investments without a clear strategy or goals can lead to poor decisions and outcomes. Emotional investing. Making investment decisions based on emotions rather than rational analysis can be detrimental. Ignoring fees. High investment fees can significantly erode returns over time. Pay attention to the fees associated with any investment. Failing to diversify. Putting all your money into a single stock or sector increases your risk. Diversification can help spread risk. Keeping perspective. Long-term perspective. Investing is most successful as a long-term endeavor. Short-term market fluctuations should not deter your overall strategy. Continuous learning. The financial market is always evolving, and continuous learning is key to staying informed and making better investment decisions. Adapting to changes. Be prepared to adjust your investment strategy based on changes in your financial situation, goals, or economic conditions. Starting with investing is just the beginning of an ongoing financial journey. As you gain experience and your financial situation evolves, your strategies and choices will likely change as well. Remember, there's no one-size-fits-all approach to investing. It's about finding the right strategy that aligns with your goals, risk tolerance, and timeline. If you're finding this video helpful, don't forget to give it a thumbs up and consider subscribing for more similar content.